Alex, thanks for joining us in the RA Conversations. You are very well known for your research into the topics such as executive compensation, corporate governance, socially responsible investing. In 2011, you published a paper at Journal of Financial Economics titled, "Does the Stock Market Fully Value Intangibles, Employee Satisfaction and Equity Prices?" Can you set up some broad framework for us? Should things like employee satisfaction actually really matters in terms of corporate performance or stock market returns?
Sure, yes, employee satisfaction could matter for corporate performance, but it's not clear which direction it matters. So there's two schools of thought. So one school is actually employee satisfaction is detrimental to firm performance. Why might that be? Well, the way that you can make your employees happy is you might pay them too much and not work them hard enough. And there are actually reasons why a manager might want to do that. For example, it just takes a lot of effort to reduce the employee's wages. She might just enjoy better working relationships if the workers are better paid. And if you look nowadays, the ratio of the CEO pay to worker pay is being disclosed. And actually, if the CEO pays the workers more, she might be able to justify higher pay for herself. So that's the dark side. But there's also the bright side, which is if you treat your workers well, then you'll be able to hire better people, they'll stay longer, and they'll be more productive and motivated. And even that's not obvious, because you might think, well, the way to motivate your workers is you use a contract, you might count the number of widgets a worker produces and pay him per widget. But nowadays, in the intangible economy, a lot of the things that you seek from workers can't be measured, like mentoring subordinates. So the way to actually motivate them is to make them happy to be part of the firm and to be inspired by the mission of the company.
Thank you. Can you maybe dive into a little bit details about your findings in your research?
Yeah, so what I wanted to look at was the link between employee satisfaction and performance. So there's two things I need to think about. First is, how do I measure employee satisfaction? So what I used was the list of the 100 best companies to work for in America. That's a list which has been available since 1984. So that gives me tons of data to make sure it's not just due to a few years which are outliers. And also that list is really thorough. So it doesn't look just at quantitative factors like pay and benefits, but it also looks at qualitative factors such as trust in management, pride in job, and camaraderie with your colleagues. And then I also had to look at, well, how am I going to measure financial performance? Now, I didn't look at valuations or market shares or profitability. The reason is potential reverse causality. Is it employee satisfaction leads to better performance, or is it better performance leads to employees being happy? So what I looked at was future stock returns. So that mitigates some of the causality issues. It doesn't completely eliminate it, but at least mitigates it, because if you think causality is the other direction, let's say good performance causes workers to be happy. Well, if performance is already good, the stock price should already be high. So the future stock return shouldn't be any higher because the stock price should already be high today. And so that's one way in which at least I mitigate some reverse causality issues.
What surprises me a little bit here is how could the market miss that? Why didn't the investors actually realize employee satisfaction actually matters for corporations and start bidding up the prices for the firms listed in the best companies to work for list?
Yeah, that's a good question, because I mentioned at the start there's two hypotheses for why employee satisfaction might either be good for stock returns or bad for stock returns, but there's a third, which is there should be no effect. Because let's say even if it was good for stock performance, if the market recognised that, as you say, it should already be priced in. But why I argue that it might not be priced in is for a couple of reasons. Number one is it's actually ambiguous whether it's positive or negative, as I said earlier. And indeed, some of the early research actually suggested that if you treat your workers better, stock returns go down. So there was a famous study in the AER which shows that when there was a pay increase, stock returns fell dollar for dollar, suggesting it's a zero-sum game. So maybe the market is fixed in this zero-sum idea. Or secondly, maybe the market does recognise that employee satisfaction matters, but it just doesn't pay attention to the information because it's not very salient. And there's a lot of other research suggesting that intangible factors aren't incorporated into stock prices. For example, there's the famous study by Gompers, Ishii and Metric showing that if there's better governance, stock returns are high. Now, you might think it's obvious that if the firm is better governed, performance should be higher. Just like if employees are happy, performance should be higher. But despite those governance measures being public information, the market didn't take it into account. Why? They're good at looking at things like earnings and profits and dividends, but less good at incorporating intangible factors like governance or employee satisfaction.
In your study, have you really conducted any subsample analysis to show whether there is any change in the magnitude of the abnormal returns as the investors become more aware of the potential benefits to those socially responsible employers?
Yes, I looked at that, and that's because, as you say, the stock return performance depends not only on whether employee satisfaction is good, but the extent to which the market does not recognise it. So what I looked at was, did things change after 1998? Why is 1998 interesting? Well, before 1998, the best companies list was only published in a book. After then, it's been published in Fortune magazine, which nowadays has 20 million viewers, both online and in print. So you might think after 1998, the results should disappear because everybody knows about this. But interestingly, I found that the results were stronger after 1998, not weaker, and that suggests that even if the market is aware of this information, they're not taking it into account. Maybe because they have this view that an employee-friendly company is just fluffy and distracted from the bottom line, and therefore they don't see it as a positive investment criterion.
Your research, is pretty supportive of socially responsible investing can be potentially beneficial for investors.
Yeah.
But we all know socially responsible investing is a very broad topic. The information there can be overwhelming and confusing to investors. So could you please maybe comment on what do you think really works for socially responsible investing? What investors should be looking for when they start evaluating, ESG type of strategies?
Yes, and one of the most difficult pieces of data for the socially responsible investing movement is that the average SRI fund does not outperform the market. So you might think, well, that's strange that my paper finds a dimension of performance that does outperform. But I think it's important to distinguish between socially responsible funds and socially responsible criteria. So why some funds might not actually be outperforming is they might be using the wrong criteria. So why I chose employee satisfaction is that employees are material to almost every company. So in every company, employees are a key asset, and so that's why there's good reasons for why there should be a link between them and future stock performance. But there's other dimensions of social responsibility that certain funds use which might not actually be material. So perhaps Catholic values, it might not be so clear why in some industries that should lead to outperformance. Animal rights might matter in some industries but not others. And if some funds engage in, say, one-size-fits-all diagnosis of whether a company is responsible, then they're not looking at the correct screens. In fact, there was a paper after mine in 2016 in the Accounting Review which looked at materiality. So what they did is they looked at companies that performed well on social dimensions across the board. And they actually found that they did not outperform the market. Then what they did is they looked at companies that outperformed on material dimensions. So those are the ones that mattered given its industry. Let's say healthcare, that might be environment, financials, that could be customer trust. And that underperformed on immaterial dimensions. And those did outperform the market. So it actually suggests that for social responsibility, more is not always better. You like to focus on the material issues and actually not focus on the immaterial issues. And that's what maybe some socially responsible funds are getting wrong.
Do you think there is lots of value from translating your research insights into an investable strategy? Are there any caveats we should be watching out?
Yeah, I think there's a lot of value to translating this, and this is why I'm really excited to be part of Research Affiliates, which takes rigorous academic research and then tries to apply this for practical questions. And indeed, there's a fund that does this. So there's the Parnassus Endeavour Fund. It used to be called the Parnassus Workplace Fund. They changed their name because they don't just look at healthy workplaces, they also look at fossil fuels. But in 2017, Morningstar did a study showing that it was the best performing large cap fund over the past 1, 3, 5, and 10 years. I believe that since its inception in 2005, the market had returned 8.3%. It had returned 12.5% per year. So I think this is serious stuff. So, and it matters because, and what drives results are two things. Employee satisfaction is good for firm value. rather than representing managerial slack. But number two, not only is it good, but many investors don't recognise that it's good, and therefore it's the ideal criterion to invest on.
What is the magnitude of those abnormal returns for those best to work for companies in your study?
So what I looked at was the 100 best companies to work for, and I compared them to other companies in the same industry or of similar characteristics, and depending on the benchmark, I found that they outperformed by 2.3 to 3.8% per year over a 28-year period. So that's 89 to 184% cumulative.
Thank you very much for sharing your thoughts here.
Thanks very much, Faith, for your interest.